know the song, right? It's Christmas season. To honor that season, we can't give you a partridge or a pear tree, but we can give you a pear trade. Chris Verrone is over at the Plaza with a little holiday wish or something. Go ahead, Chris.
We're going to talk about two pairs we like a lot for 2020. We'll start on the short side. We have Amazon, obviously very important name, biggest weight in discretionary. I think it's lost on a lot of people. The stock hasn't made a new high in 330 trading days. It's the longest it's gone without a new high in the last 10 years. So it's really been dead money here. It is just hanging on vulnerably below now a flat 200-day moving average. I think if you start to see this break that 1720 level, the stock trades 1760 today, below 1720, I think it reinforces the short case. But what do we want to pair it against? I think we want to pair it against its competitor on the other side of the world. This is Alibaba, which is the exact opposite picture, much like we saw in 2015 when this started to bottom and turn up as cyclicality reemerged around the world. We're seeing a very similar chart right here. I like the fact that the 50 and 200 are now upward sloping. I like the fact this has really reemerged as a global cyclical leader. So what does it look like if we pair them? This is your P&L if you're long BABA, short Amazon. So to make sense of this, Alibaba's underperformed for the better part of the last 2 years. That has started to change pretty meaningfully over the last 12 months. We think that continues into next year. The other pair that I want to talk about, very similar, another name, Netflix, which has just not participated in this move this year. It peaked about a year ago, made a lower high this summer, still stuck below its 200-day. Stock was actually down today. On a risk-on day, Netflix down today. So what do we like it against? I continue to like Disney long. I think this is a great pair against Netflix. It's only a couple months ago that Disney broke out of this huge 5-year base. We have good support right near the 50 and 200. I think any consolidation is an opportunity to get long here. And again, if we pair these and think about what our P&L looks like, this is long Disney, short Netflix. Again, Disney was the underperformer for much of the last several years. That has really started to change over the last number of months. I like Disney long versus Netflix. I like BABA long versus Amazon.
Wow, good stuff there. Chris Verrone, why don't you come on back now?
Bring him back.
Let's trade this.
I love what he's doing there. He's also putting Disney on there against Netflix because really the driver for Disney's breakout really was Disney+. Love BABA over Amazon. BABA's breaking out on a 2-year consolidation, as you pointed out. It's also 20 times on their e-commerce business, 30 times on their cloud. Makes it a lot cheaper than Amazon. You're not even really valuing Ant Financial, which is $50 billion. We talked about some of the parts earlier. Love it. And on Disney, look, forget Disney+. This studio is just continuing to crush it. Frozen 2 did, it's already over $1 billion. This is going to be probably their $6 billion franchise. They got Star Wars coming. That's the gift that keeps on giving. Love that trade as well.
Yeah, I would just add this on Disney, and I think his charting was really interesting. You know, for 5 years, you could have sold Disney at 120, and it was a great sale every single time until earlier this year when it broke out. And I think the point he's trying to make is, if it goes back to that 130 breakout level, you just keep buying it there because you might see a new range established here, especially with the fundamental drivers that seem to be a tailwind for years to come.